Welcome to Market Catalyst. I'm Ali Canal. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, sticky inflation weighing on Wall Street's rate cut outlook. Full coverage ahead. Plus, retailers grapple with yet another tariff hurdle, details to come, and Alibaba's AI hopes offsetting slowing revenue. All that and more coming up on Market Catalysts. Let's get a quick check on the markets here. We are seeing losses across the board. Losses are escalating from where they were earlier this morning. You're seeing the Nasdaq down around 0.9%. The Dow was off roughly 100 basis points, and then the S&P 500 is off around 0.5%. And this comes after PCE data came in mostly in line with expectations, although we did see that core reading come in at 2.9%, so significantly above the Fed's 2% inflation target. And it's interesting to take a look at what's happening in the bond market and longer-term treasury yields, because you're seeing those tick up a bit. We have the 10-year yield up around 3 basis points. The 30-year yield is up around 4 basis points. Now, it's interesting because the expectation is still that the Fed is going to cut rates in September. However, the fact that we're seeing this steepening of the yield curve suggests that maybe there's an inflation premium that investors want, that they think inflation over the long term will be higher. So that's something that we're going to continue to track. But once again, the Fed's preferred inflation gauge, core PCE, in line with estimates both month over month and year over year. Still, that core figure did come in at 2.9%, well above the Fed's 2% target. Joining me now is Jose Torres, Interactive Brokers senior economist. So, Jose, how are you viewing this latest inflation data and what it means for the next move for the Fed, considering that markets are still banking on that September rate cut?
Good morning, Ali. Great to see you. Well, I thought the data was a little hot, but what's driving the heat, Ali, is actually services. Goods, we saw deflation in goods. And the reason we're seeing services inflation begin to climb is because pricing power among servicers is tremendous. You know, in the first half of the year, we were all worried. There was a turbulent and uncertain landscape with Liberation Day tariffs and what was going to happen. We saw mean sell-offs in equities and fixed income. Rates went to the nosebleeds. Stocks went to the basement, down roughly 20% from their highs. But now in the second half of the year, Ali, we have a much more buoyant landscape ahead. Consumers are adapting to what this feels like, this higher goods tariffs environment. Businesses as well, they kind of know that we're going to have a better path ahead. The uncertainty from the first half is now behind us. And what we saw is that services, you have pricing power because consumers are really out there spending. Real-time gauges of consumer spending, of hiring, and of corporate investment have really shot up starting in July. And as far as services, that could continue to be a problem and push the overall price indices to 3%. Final point here, last time during Trump administration 1.0, we saw in July 2018 the CPI get up to 2.9%, but then it retreated down to 1.5% a few months later in February of 2019, and a lot of that was driven by the same factors that we see now. Corporates weren't positioned to handle this surge in demand, and for that reason, they're raising prices. Airfares up roughly 4% month over month, the strongest increase since Russia's invasion of Ukraine back in 2022.
And you bring up a great point on the dangers of higher services inflation, considering that doesn't have a direct tie-in with tariffs. We would see that impact on the good side. And heading into the past month, really, we have seen services decelerating. So if that's now re-accelerating, does that suggest something more sinister is perhaps going on underneath the surface when we look at inflation? Because that's going to make it that much harder for the Fed to control.
You're absolutely right, and that's what we're dealing with in markets right now. But I don't think it's a bad development. I think that it bodes really well for economic growth prospects and corporate earnings going forward. However, the October and December cuts, those are a little more of a question mark, because if the CPI is at 2.7 now, if it starts to ramp up to 2.9, 3%, then it's tough for the Fed to really dish out a lot of cuts. Our prediction market is expecting a lot of cuts. By the end of next year, Ali, a rate of roughly 3% on Fed funds. If the CPI and the overall PCE is at 2.9% or 3%, can the Fed really get down to 3%? I don't think so. But I still think that we're going to have a few rate cuts. I think we're going to have roughly 3 to 4, place us somewhere in the mid threes. And I think inflation is going to remain steady at 2.8%, 2.7%, right under 3. However, there is a risk, of course, of it climbing faster. And then another pivotal component here is that the services inflation has been non-housing services. We know that the immigration restriction and still elevated mortgage rates has really been weighing on the housing market from both a price and rental perspective. So it's non-housing services, a lot of discretionary things going on. Like I said earlier, a lot of travel, a lot of eating out, a lot of folks spending money. What's helping the lower and middle income cohorts is a subdued unemployment rate, subdued firings, tight labor markets that are now beginning to strengthen, by the way, as of mid-July. And of course, what's helping the wealthiest consumers is a buoyant capital markets. S&P 500 up roughly 10% year to date, following 2 consecutive years of 20% plus gains.
Mm-hmm. And you brought up housing, and there's been a lot of concerns over housing affordability, especially for people my age, the millennial cohort. I'm curious from your perspective how that could change the long-term economic outlook if you have people that are younger not able to afford these homes, how that impacts their home equity and their ability to spend down the line.
It's a significant consideration. It's a big demographic shift. We've seen it throughout the decades. I think that if the immigration policies begin to change, then all of a sudden that's really going to bolster the residential real estate market, and you're going to have better affordability dynamics. But you also need lower long-end interest rates. Like what you were saying earlier about why rates are rising at the long end, I think part of it is Fed independence concerns and whether, politicians will have too much control over what goes on at the Fed. They already have somewhat control. They get to choose the chair, they get to appoint governors, here and there, albeit those are long terms. So they do have control, but if it really becomes more of a politically controlled central bank, then there are risks longer run that mortgage rates will remain higher. And just like you said, the millennial community, I'm part of that community as well, that cohort. It's really hard for affordability to come into balance with rates above 6%. You need rates at 5.7, at 5.5, and that'll really bolster transactions.
Yeah, a lot to keep track of. Jose, thank you so much for breaking it down for us.
Pleasure. Thanks so much.
Coming up, how retailers are contending with the evolving tariff landscape and a strapped consumer. That's next.
Made a net tariff impact of approximately 100 to 110 basis points to our operating margin. That's about 150 to 175 million to fiscal 2025 operating income. Look, these are circumstances we are all dealing with, but what we need to make sure, particularly in our portfolio, is that we are not compromising the long-term integrity of our strategy.
That was Gap CEO Richard Dixon speaking about how the company is handling tariffs. He tells Yahoo Finance that the company believes it will be able to mitigate all impacts in 2026 and beyond. That includes both steep taxes on imports from many countries, as well as the end of the de minimis exemption that allowed packages worth less than $800 to enter the country tariff-free. Here with more on the challenges retailers are facing is Mickey Drexler, Alex Mill chairman and veteran of brands including Gap and J. Crew. Mickey, thank you so much for joining us again. I mean, look, tariffs, they're not good for any of these retailers. When you look across the various strategies that some of these retailers have done, whether it be absorbing costs, passing costs onto the consumer, pulling forward demand, what works best?
Well, there's a multiple choice here because I think we're all flying blind. We don't know yet what's going to be. But it's not going to be easy. That you can't control the controllables right now. You don't know what the cost of your goods are relative to retailing and margin. And we sit with pins and needles, for example, on China, which is America's factories. A lot in China, needless to say. And a lot of people are using China for their manufacturing, even small little parts. So I think we haven't seen the worst of it uh, at all. But, I know as much as anyone else knows, not that much.
Right. And if you can't control the controllables as a leader of a retailer, what can you control?
Well, the one thing long term, you can control your product, and the goods are always number one. And Alex Milnow is kind of having a nice moment. I'm liking very much. I don't get too, I'm superstitious, but it's about the merchandise. And it's not about having algorithms. It's not about the data. It's about what you do with the data. How do you see down the street? What's the message from the consumer? And that's what will make it best. And I'm not a discounter brain. I think discounting is doing very well from what I hear, except with always exceptions. And I think the tariffs, they're hurtful. And inflation at 2.9%. I don't know if they've ever been to a supermarket or a clothing store or traveled, but food prices, from what I see, just as a consumer, are way up, and clothing is up, up, up. So it's a lot of confusion going in. And if people say that they have the answers, I wish they would give me a call and tell me what they are.
So you say it's important to listen to the message that consumers are telling you. What is that message? How has the consumer been responding to all of these uncertainties when we talk specifically about retail?
In terms of what the consumers, I'm in the stores. We only have 3, and I'm on the phone, and I'm talking all the time. I'm a detective about what the consumers want. And tell me, my go-to people have always been the store people or the online team, and factory floor. We don't go there. But what they're saying is I'll tell you what I hear anecdotally. Designer prices you need a mortgage for. They're very expensive, and most things, my own observation, a lot of discounting out there, as always, and it's been a kind of a chronic illness for many years. So what is the real price of something I'm buying? And then people are waiting for sale, because why would they pay $30 or $40 more if they know it's going on sale? But they always tell us they like the nice goods. In my experience, you put something into the shops online, like our totes right now, and they tell us they like it. They like some of we know what they like. It's bestsellers, and we have to invest at the right level in each of them.
So what does this say about consumer bifurcation, that high-income consumer versus the lower income? There's been some retailers out there that they're actually seeing higher-income consumers trading down. Others say that the lower-income consumer is doing terrible. So it really feels like this mixed picture. What have you seen? And is there even a middle-income consumer anymore?
Well, I don't know. You said traders tell you that?
No, trading down. So they're not going for
who knows? I think, personally, I'm a high-low consumer. I don't want to pay more for something that someone else is selling for less. I always say, when you go to the cash register or wherever online, and before you give your credit card, go online and look for the exact same thing you're buying. And that's why I always say TJ Maxx, kind of my favorite, and honest prices every day. And so I think there is a trade now. But to answer the question, I think discounters are certainly having a day. But their reports were pretty good. TJX, Carol Meyerowitz always best in the business. Why? Best buyers and real prices. And the business they do with brands, they're in many cases the brands' biggest customers, and you can buy those brands everywhere else. We do business with them but we're so smallish but they drive hard bargains. But they are, what, 50, 60 billion dollar company. And then you compare them to the department stores whose, share is getting tougher, I would guess.
And another thing consumers are paying attention to is the celebrity aspect of brands and the partnerships that we're seeing across the board. What is your view of some of the controversy that's come out of the Sydney Sweeney campaign, for example, with American Eagle?
My view is it was a moment, a bit overblown. I said this week they should apologize. Someone argued with me. I said, then just say you made a mistake. That word in America is not used that much. There's Sydney, I see. I made a mistake. It's going to be old news. I'll tell you what I think is going on in the world, and I use the word authenticity, the real deal. Don't read the PR report on how business is. For me, it's always been just say what you think. Some people might not like it. I get into trouble not a lot on that. But I think that natural, authentic, old is the new news, and clothes should never be worn for a season only. But that's personal. I've always been that way in all my jobs. Clothes needs to, that denim, whatever it is. Oh, it's a jumpsuit, I think.
Jumpsuit.
Oh, then it's not an easy sale. I thought it was like a denim shirt. I like classics. The shirt I'm wearing is 2015. So it's 10 years old. I get them custom in Hong Kong. But if you amortize expensive stuff, because a button down, I wore this shirt as a kid, not the same one. But, it's we say uniform. It sounds like a boring name. But a point of view, simple. I looked at the individual style campaigns all over our office. And I did I don't know if I did a LinkedIn and or an IG. Those clothes, 30 years old, that we did, which I thought was a brilliant campaign that our team did. Same clothes today. The 50 people with 3 or 4, they all look cool. They all look not out of date. They look this. And of course, there's changes you have to pick up on. But, the merchants decide on that with the creatives. And AI will, and I had fights on this. I love this debate. AI is not going to pick colors. It's not going to have emotion. It's not going to work with factories negotiating. And it's not going to interview the most important thing, or me, the team members. So AI, it's great. I am not a technology person, but I have partners who know. And so there's a lot of stuff going on that, there's a lot of lemmings out there too. AI will be great, I'm told. It'll be more efficient and that. But I don't believe in common wisdom because I believe in the unexpected is much better than the expected. I find that always with us. Give them something that, oh my God, they notice, but it's always brand right.
Well, real quickly, Mickey, because you brought up a good point about trends, right? And how trends often change. And we've even heard on the supply chain side that a lot of companies, they aren't leaning into the trends as much as they have before because they want to save as much money as possible. So how do you think that changes the fashion landscape and what these retailers ultimately rely on?
I can't answer that because I'm not other companies. I always, and I don't, I learn a lot from other companies all the time. I only learn the stuff we should be doing better. But, clothes are, and there's trends out there that I don't understand them, but I respect them. Like the teenagers are buying some brands like crazy. I've always had the same playbook: nice clothes, point of view, quality for the price, and taste and style, colors. There's a lot of things in our business that require, and people argue about this, intuition, judgment, experience. Terrific people who work with you can help you in all those areas. And I'm a micromanager very proudly, because if I don't notice the details that are tiny, who's going to notice the big details? And the big details are very big, and the small details accumulate to make you a better person when it comes to customers. And so that's right. I take every customer call. Now, we don't get as many as we used to, or emails. It's respect. And I don't know how many people walk the floors. I don't know how. I'm talking about the senior people who are the bigger bosses. I'm studying CEOs now. It's fascinating to me. I'm in a master class after all these years of listening to people who who they are, Enzo Ferrari and this one and that one. And wow, I just listened to Arcadia this morning. This Mr. whatever, he's IK or his initials, incredible stories. And they all share a lot of the same characteristics, which I hope I'm sharing most of them with them. So I don't know about the factories. I don't know about that. I always look at competitors. I learn more from our competitors, by the way. Right. It's like you visit a shop and you get the whole story from a salesperson. And that's one of the rules we have. You want to know what the best sellers are? I go in and I say, I want to get a nice gift for my daughter. She was 12 years old when I started. Now she's, 30-ish. And I said, tell me your 5 best sellers. There you are. You don't have to take, hire a consulting group, which I won't get into. You don't have to do focus groups. By the way, these people, and they are the creme de la creme, they don't do focus groups. I never did one. I did one twice when my board forced me to, and that was it. They won't make a living off of me. But I'm a contrarian, so you can interrupt me anytime.
No, well, I love your passion for this industry. Clearly, you're on the pulse of everything going on with the retail sector right now, and consumer trends are obviously changing amid this environment. But Mickey, thank you so much for being with us. Really appreciate your insights.
Thank you very much. I appreciate it. Anytime.
Great. All your market action is straight ahead. You're watching Market Catalysts. Now time for some of today's trending tickers. We're watching chip stocks, Caterpillar, and Celsius. First up, chip stocks. Intel, SK Hynix, and Samsung specifically. The U.S. is tightening chip restrictions on China, revoking earlier permissions that allowed some companies to receive American semiconductor manufacturing equipment there. That's according to the Federal Register. Those companies have been granted carve-outs from sweeping 2022 export controls, but now they'll need specific licenses to buy U.S. equipment in China. Next, Caterpillar. Just 3 weeks after reporting earnings, Caterpillar is warning that tariffs could hit its business even harder, costing as much as $1.8 billion this year. The heavy machinery maker, one of the world's biggest suppliers to mining and construction, already saw tariffs eat into its second quarter results, with costs landing at the top end of its earlier estimates. Finally, Celsius. PepsiCo boosting its stake in the energy drink maker in a $585 million deal. PepsiCo is buying convertible preferred stock in Celsius that will boost its ownership to 11%. That's according to an announcement today. The deal will boost distribution of some of the energy drink maker's popular beverages. The company also recently acquired energy drink maker Alani Nu, which will now be PepsiCo's distribution system. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Alibaba shares are popping today, up 13% nearly, as China's AI boom fuels higher than expected sales in its cloud business, offsetting a drop in its e-commerce unit amid tough competition in the food space. Joining me now is Brian McCarthy, McClellan's managing principal and chief strategist. Brian, thank you for being here. And it's an interesting report from Baba, considering that we're seeing some of the tech initiatives, the AI side of the business, offset some of those concerns when it comes to the consumer. So how did you read through this report?
Yeah, really a mixed report. Not good on the headlines, with adjusted net earnings down, I think 18%, revenues down 2%. But if you strip out businesses that they have sold in the last year or so, the revenues were up 10, e-commerce up 10, and the market really liked the cloud business growth in revenues at 26%. That was really the highlight. The market is really taking a glass half full view of these earnings. Pretty impressive gain in the stock against a backdrop of a very weak U.S. equity market today. So obviously the market liked what it saw. The conference call was interesting. We went into the conference call with the stock up 3 or 4%, and the questions out of the chute were all about this quick commerce business and concerns that the analysts had that it's a bit of a money pit. As you mentioned, the food delivery business is hyper competitive. And the management did a pretty good job of batting away those concerns and arguing that the increased sort of touch points and usage that those businesses will involve will end up feeding the core e-commerce business. So again, market took a glass half full view of that. And then the stock really started moving when the questioning turned to the AI business, which, as I noted, is growing quite robustly in revenue terms. But the glass half empty aspect there is the margins are very tight, below 10%. For comparison, Amazon's cloud business is above 30% margins. So, there's this problem in China where companies go for scale, and there's always question about whether it ends up in profitability. We've seen this in the auto industry. But as of this morning, the market is viewing that glass as half full and liking the growth in revenues that we saw.
Right, that broader portfolio for Alibaba really helping shares today. So clearly, like you were laying out, investors are focused on that cloud business. But is that the side of the business that they should be focused on? Were there any greater concerns on the consumer side?
Well, the 10% growth in the e-commerce business is pretty impressive in an environment where Chinese consumption is still pretty much flat on its back. The macro data out of China has been extraordinarily weak in recent months. The real estate market taking another downturn when everybody thought it would stabilize this year. So it's a very, very difficult macroeconomic environment and will continue to be so. So, I think the results were pretty impressive given that backdrop.
And speaking of AI, Alibaba has reportedly created a new AI chip to compete against NVIDIA amid some of those U.S. restrictions that we're currently seeing. How significant is that development? Is this a real step forward for China in the AI race?
Yeah, unclear as to what the parameters of this chip they've developed, how efficient it is. What is clear is that the Chinese don't want to get hooked on our tech stack, as Howard Lutnick put it a few weeks ago, apparently raising the ire of Chinese policymakers who are seemingly telling these Chinese tech companies not to buy the NVIDIA chips. They want all of this to be run on homegrown stacks. That also is going to be a highly competitive business. But to the extent that China says it doesn't want NVIDIA chips, obviously there's going to be a much bigger revenue pie in China for these chip makers, which are also trading very well more recently. However, the entire system is going to be run on a less efficient basis. But China's okay with that, so they can build their stacks with just more chips that are less efficient in terms of energy usage, and maybe plug it into some 100 square mile solar farm that they're not using otherwise. So they've got excess capacity across the system, and again, the whole Chinese system it seems to be more about scale than profitability, and that's been a story for well over a decade in China now. It's no different with this cloud computing business or the chips. But again, for now, the market seems okay with the scale. And I would add that the backdrop for Chinese equities right now is pretty positive in terms of speculative fervor in China kicking up against the backdrop of trade concerns that seem to be on hold for now. But again, you did mention the export control licensing requirements for Intel, SK Hynix, Samsung. If this is a return for tit-for-tat export controls between the U.S. and China, that could dent this speculative sentiment that's quite healthy in China for the time being.
Right. I guess to follow up on that point, Brian, we still see talks ongoing between the U.S. and China. How much of a risk is that to not just companies like Alibaba, but the whole Chinese market if we do see further escalation here and the two countries are not able to strike a deal?
Yeah, I think it's a very big risk. Not imminently, but we did have Treasury Secretary Bessent recently tell us he expects the next meeting with China to be in 2 or 3 months, not until just before the next deadline for the tariff respite, which comes up in early November. There was a Chinese trade negotiator came to DC this week, and they didn't really seem to want to meet with him. The Chinese seem to want to offer to buy soybeans. Now we're entering into the big harvest season in October through January, and they're not ordering U.S. soybeans yet. And by reports, the U.S. said they don't really want to take meetings. So the U.S. does not seem keen to make a deal. And I think the market, again, if you want to look out to November and beyond, is a little too complacent about where this is going to head. My own view is that the U.S. is just trying to drag things out until the U.S. side can see some light at the end of the tunnel in terms of domestic rare earth and magnet production, which will never be as efficient as China. It will never be as cost effective as China, but it's a small market. It's easy to subsidize, and that's the approach they're taking. So I think if you want to look out 3 to 6 months, there's a lot of risk there, not in the next 3 to 6 weeks.
Right. And that's something that investors have been tracking for quite a bit now. I want to go quickly back to that Alibaba news developing their own chip. It's interesting because Alibaba was once a huge NVIDIA customer. How much do you think this changes the calculus when it comes to the U.S. tech dominance in China? Because we know that NVIDIA chips, they're far and away above the rest of the pack, right? But do you think that this news maybe changes that in the future?
Yes, China's approach to chips is the mirror image of our approach to rare earths. We can't be dependent on China for these rare earths anymore. We just have to subsidize the production here. China's going to say, we don't want to be dependent on the U.S. for chips. We're just going to subsidize the production. So they'll use less efficient chips, and the energy will be subsidized if they're less energy efficient, and through various subsidies, they'll run things on a less efficient basis to avoid the cost of becoming dependent on the U.S. So my own view is that the geopolitical situation, bilateral relations, don't bode well for NVIDIA's business in China. I'd like to make one more point regarding the AI growth in Alibaba, the cloud computing growth. There's one potential black cloud on the horizon here, which is last night, the central planners in China, the NDRC, came out and said they don't want willy-nilly crazy investment in this sector, which has beset them in solar panels, autos, and a number of industries. And they've told the local governments to, don't go crazy, be a little rational about this. Now, they don't have a great track record in controlling these local governments when it comes to these investment splurges, so nothing may come of it, but they are saying they want to tap the brakes a little bit on the AI investment, which might, when that news sort of gets absorbed by the market, take a little bit of the steam out of this Alibaba rally we're seeing today.
Yeah, great insights there. Brian McCarthy from Macro Lens. Appreciate it.
Thank you.
All your market action straight ahead. Stay tuned. You're watching Market Catalysts.
NVIDIA. Did retail traders get it right with NVIDIA and AI?
Yeah, maybe not this earnings report in particular, but retail has been buying the dip since April around the tariff news. The DeepSeek sell-off from earlier in the year, they were also buying the dip. So they're big believers in kind of the broader AI trade, and NVIDIA is one of their top picks. But expectations just got so high coming into this print. It's getting harder and harder for Jensen Huang and the company to kind of top themselves each quarter. And the stock was up 110%. Since the April lows. So expectations were quite high going into the print, and we didn't quite see enough to get people excited to keep buying.
Yeah, it's been surprising how much retail traders have really bought the dip when it comes to NVIDIA. I mean, every single dip this year has been bought. Other areas of the AI trade, what are some of the other touch points that retail traders have been looking at? Yeah, people are looking for value right now. If you look at NVIDIA, it's up 1,700% from the fourth quarter of 2022. It's up 1,200%, over the last 18 months or so. So people are looking for the AI theme in general. They're looking for other areas and saying, okay, if data centers require all this energy, solar is going to play a role in that. So they're buying solar stocks that have been beaten down for a variety of reasons. They're looking at cybersecurity. They're saying, all right, AI infrastructure, cybersecurity is going to be key. They're looking at robotics. They're saying, okay, within AI, maybe there's a physical component of that, which players are going to be involved in that space. So people are still playing the same theme, but they're looking for areas where there's value. They haven't quite run up as much, and they can make the case for
them playing catch up over the next 6-12 months.
And you really see it with the different sectors that have led the markets this year, including industrials, including utilities as well. A September rate cut, 25 basis point, is that a shoo-in for retail?
It seems like it. That's what the market is pricing in. That's what retail is betting on. If you look at the areas of the market people are investing heavily in right now, small caps are getting rotation. If you look at the riskier part of crypto, altcoins, Ethereum, those are getting bid. And so people are basically making the bet 6-12 months from now, whether it comes in September or December, that rates will be lower next year. And so we ran a poll, 80% of StockTwits users expected at least a 25 basis point cut in September. Some of them expected more, 50 basis points. I don't think we'll quite get that, but the point is retail and the broader market is certainly positioning for lower rates.
Let's talk for a second about crypto, because you mentioned, so ETH and Ripple has been getting a bid, definitely also sort of outperforming. I mean, when you look at Ethereum versus Bitcoin, there's clearly been a rotation going into Ether. So talk to us a little bit about what retail traders are seeing with crypto. Yeah,
what traders look at is the Bitcoin dominance chart. So it's basically Bitcoin's percentage, the market cap of Bitcoin relative to the total crypto market. That's fallen from 66% down to 56% over the last 2 months. So that's a reflection of that outperformance from Ethereum and other altcoins. Now we're at this critical juncture where, Ripple, Ethereum, some of these other altcoins are testing their 2021 highs. So that's a key technical level. If we can get above that significantly and continue this momentum, then traders are betting on the broader crypto bull run to continue.
And Chinese stocks, those have been going higher. They've been getting a bid.
Yeah, so if you look at some of the popular ETFs, KWEB, MCHI, all of these are hitting 2.5-ish year highs. China is the one global market that hasn't really participated in this rally for obvious reasons, a lot of global headwinds, geopolitical headwinds, but the market is once again betting on value, betting that the geopolitical side will get cleared up eventually, and they're pricing that in now by going after Alibaba, JD.com, PDD Holdings. Like, these are names where even if we get some positive news from a geopolitical or global growth standpoint, these names will catch a bid. And so again, as people look for value, China is an area they're heavily focused on.
You know which sector has been lagging this year? I mean, healthcare, down 0.8% year to date, even though we've seen it rally recently. So what do you think is going on there? What are retail traders seeing there? And are the government headwinds that have been facing healthcare an issue here?
Yeah, healthcare is an interesting one because you've got both traders and investors interested. So if you look at XLV, which measures the healthcare sector relative to the S&P 500, it's at 25-year lows on a relative basis. So this outperformance has been happening for quite some time. But when you see names like UNH down 60, 70%, in a quick 1 year period, that attracts traders who are looking for mean reversion, looking for that short-term pop, but it also attracts fundamental investors that are saying, listen, I understand the fundamental headwinds they have, but this is a brand name in the space. They're not going anywhere. They pay a nice dividend. I get paid to wait for them to turn it around. And so we're definitely seeing a lot of people buy dips, especially in kind of those big Dow components and brand names in the space.
Playing catch up. Thank you so much, Tom Bruni from StockTwits.
Thank you for having me.
Wall Street is betting on a rate cut by the Fed in September. CME Fed Watch pegs the chances at about 85%. So what changes should you make to your portfolio, if any? Let's bring in Tyrone Ross, 401 financial principal and founder, for this week's FA Corner, brought to you by Capital Group. So Tyrone, thanks for being here. Market's still pricing in that September rate cut, but you say that investors should ignore all that rate cut noise. Why?
I think they should ignore it because what you're doing in your portfolio is personal and is part of a broader financial plan. And hopefully everyone has a financial plan. But let's break it down really quickly. I think if you are a squirreler, right, just someone that saves a lot of money, that means rates are coming down. You should probably look at somewhere better to park your money. If you're facing retirement, you probably should look at the bond allocation in your portfolio now. So it depends on where you are. So you can get caught up in the macro noise. I think you look at your plan, stick to your strategy based on age, risk tolerance, and financial goals. And I think that's the way to go, and kind of push all the noise out.
And you recommend that most investors should focus on dollar cost averaging. Why is that the best strategy, no matter what economic or market cycle that we're in?
Because first, you remove all the noise. Two, you can automate it where you're just constantly putting money into the market. So you're not so concerned about hitting new highs or bear market lows. You're consistently putting money into the market. Compounding is your friend. Go spend time with family. Love your loved ones. Go take a nice walk, but let the market do its thing. Control what you can control, and go and live your life, and just let the market do what it does, and you'll look longer term, you'll hit all of your goals along the way. But trying to manage the market is not something where folks, the individual retail investor has had success.
So how does that investment strategy change depending on your age and your needs? For example, maybe you're a younger person just starting their first job versus someone who's about to retire.
Great point there. So as you go and you're younger and you're starting to hit your peak earning years, you want to obviously find multiple ways to get money into the market and start that compounding. So if you're younger here and you're looking at where rates are, maybe you're considering buying a home, right? Your first home. So that's where you are at the younger stage. Now, if I'm looking at retirement, 3, 5, 7 years out, I probably want to look at how much risk I'm willing to take versus my longer term goals, looking at how much exposure I have to bonds now. I think, bonds is kind of a divisive conversation right now in our space, but I think you should probably look at, some allocation there based on where we are and rates coming down and locking that in. But again, it's personalized based on where you are. Retirement is changing now. Folks are working into retirement, right? Maybe taking some part-time jobs or, starting a side hustle. So all those things need to be considered, but just having the jitters and jumping just because we're going to get a cut, which is expected, but may never come as well, is not prudent financial advice. And I think having a plan that you stick to is the best way to go about it.
Now, what about crypto? There's been a lot of talk about crypto and your 401ks. What should investors know there?
Here's what investors should know that no one is thinking about. Right now, there is $72 billion worth of Bitcoin exposure in companies in the S&P 500. So all this talk about crypto and 401ks, come to the campfire, folks. It's already there. And that's not even accounting for indirect exposure that folks are already getting by investing in indexes that, again, the S&P 500, a lot of money invested in retirement accounts there. But as a crypto hippie, I will tell you that's exciting that this is going to be made available. But I also know as a financial advisor, it's going to take some time. Plan providers actually shouldn't be overjoyed about this. There's still a long way to go. A lot of due diligence to happen. I think we'll get there at some point, but there's already plenty of Bitcoin and crypto and 401k accounts.
Yeah, certainly something that investors are looking forward to, but a lot more education still needed there as well. Tyrone, thanks so much for joining us for today's FA Corner, brought to you by Capital Group. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, higher prices and slowing labor. We'll break down what's ahead for the Fed. Plus, retailers facing fresh hurdles as the new tariffs emerge, details ahead. And we'll get a read on the consumer and travel as Labor Day weekend kicks off. 90 minutes into the start of U.S. trading day, I'm Allie Canal. Let's get a quick check of the markets here. And taking a look at the major indexes, you're seeing the Dow off roughly 200 points. The S&P is down 0.8%. The NASDAQ leading the declines there, down 1.3%. NVIDIA is not helping that story. We're seeing shares there hit a session low, down nearly 4%. And this comes as PCE data came in roughly in line with expectations. But we are seeing sticky core inflation that removes volatile food and energy categories, core PCE, coming in at 2.9%. And we'll get the August employment report in the coming days. And one trend economists are likely to focus on is how the recent drop in immigration is affecting the nation's job market. Let's bring in Wendy Edelberg, the Hamilton Project Director and Brookings Institute Senior Fellow in Economic Studies. Wendy, thanks so much for being here. Let's start there with the August jobs report. We saw that very significant downward revision for July. What are you expecting for August?
Hi. So first, let me say I stepped down from head of the Hamilton Project, and we now have a fabulous new director, but I'm still at Brookings. I just want to give a shout out to our new director. So we absolutely have seen a slowdown in employment growth. And in my analysis, that has actually coincided pretty well with a slowdown in labor force growth. So because of the significant slowdown in immigration, and in fact, I think this year we're probably on track for negative net migration for the first time in over 50 years. Because of that significant slowdown, the labor force is barely growing. And if the labor force is barely growing, that means employment's going to barely grow. If the labor market's going to stay healthy and we're going to have, inflation that's anywhere close to the Fed's target. So when I look at these employment readings, I say this is basically what we can now call a healthy labor market.
Okay, now you did note that the U.S. may be close to a tipping point where job growth itself risks fueling inflation because immigration is so low. Can you explain that threshold for us and why we might be at that tipping point?
Yeah, so anytime you think about an employment number, that when we open the newspaper or open our computers on the first Friday of the month, whether it's 150,000, 100,000, 50,000, those numbers are pretty meaningless without knowing what we should compare them to. What's a healthy number? So 150,000 in an economy that has a booming labor force because of, let's say, booming population growth and booming immigration. 150,000 may well be a very weak number that alarms policymakers and makes them think that the labor market is much too soft. You need a point of comparison. And right now, we probably have very weak labor force growth. And so what that means is that the point of comparison is a number that might be as low as 10,000 a month. And in fact, I think we're on track next year, the year after, to actually have a shrinking labor force month after month. And that means in a healthy labor market with a low unemployment rate and nice wage growth, we're going to see the first Friday of every month actually negative payroll growth. And that won't mean that we're going into recession. That will simply mean that we have a shrinking labor force. And, that's the policy we've chosen. If you want like a sense of how this could play out in a strong, rich economy, think about Japan. In Japan, population growth is slowing, labor force growth is slowing, and month after month, they see negative payroll employment. And that doesn't mean they're going into recession. That just means that's what their demographics look like.
So does that change then which number we should focus more on when we look at the labor market in totality? I know everyone talks about the unemployment rate, but if you have the supply side shrinking, the demand side shrinking, so the numerator and denominator is still going down, that means the unemployment rate is going to stay low, right? So is that still the best reliable indicator on the strength and health of the U.S. labor market?
Yeah, absolutely. We should be laser focused on the unemployment rate. But what it also means, for monetary policymakers who are going to be thinking hard about these numbers and poring over employment reports along with all the other economic indicators, they still should be looking at payroll employment growth. They just have to change their frame of reference when they interpret it. But we also have quit rates. We have job openings, we have, how long people are unemployed. There's lots of measures that we can look at to get a sense of how healthy the labor market is. But it's going to take a radical reframing for people to understand that a healthy labor market right now means employment growth of 30,000 with that number declining over time. It's just going to mean we need to change our frame of reference to, understand the reality of the demographics, given the policies we've put in place regarding immigration.
Right. I think that digestion period will definitely take some time there. And what about the sectors that you think will be most impacted by this immigration slowdown?
So, we have lots of evidence showing us which sectors immigrants are, disproportionately hired in. And it's, food production, it's the agricultural sector, it's the construction sector, it's, important parts of the healthcare sector, home healthcare aides. And what we're going to see is that likely those sectors are going to have to shift more to automation, just as we've seen in other countries that have shrinking labor forces. Those sectors are just going to have to do more automation, and prices are going to rise, let's say for food, for construction, for home healthcare, and that's going to reduce demand and just naturally shrink those sectors.
So broader picture here, when we talk about the Fed and how they're setting policy, how does this change their approach when we look ahead to interest rates and what's coming down the pipeline?
So again, as I said, there are so many indicators of the labor market that the Fed should be looking at, including the unemployment rate. So they should be looking at the labor market right now, and if they agree with me, thinking this is actually a pretty good labor market given what we're doing with immigration. And so that should be their interpretation of the numbers. But they're just like everybody else going to have to change their frame of reference for what healthy employment numbers look like.
All right, Wendy Edelberg, Brookings Institution Senior Fellow in Economic Studies. Super interesting stuff. Thanks so much.
Thank you. Good to be here.
Coming up, Labor Day weekend travel surpassing records, how consumers are benefiting from lower costs. That's next on Market Catalyst. Labor Day weekend travel breaking records this year as consumers take advantage of lower prices. According to AAA, domestic flight, hotel, and car rental costs have dropped compared to the weekend last year, with domestic round-trip flight prices down 6%, hotel prices down 11%, and car rental prices down 3%. Joining me now is Clint Henderson, the Points Guy managing editor, and Robert Sinclair Jr., AAA Northeast senior manager. So, Robert, we were just talking about those AAA stats. Yeah. Going to be a really strong Labor Day weekend. What's driving that?
Well, gasoline prices certainly help. We're at $3.20 a gallon, 16 cents less than where we were last year. But in just the last week or so, we've seen a spike about 6 cents per gallon, with a lot of the Midwest seeing double-digit increases as far as the price of gasoline due to problems with a particular refinery in Indiana. But overall, we're seeing all of these lower prices and lower demand, really, because of the fact that a lot of people from overseas aren't coming to the United States this year, particularly from Canada. AAA is one of the largest leisure travel agencies in the country, and we're seeing markedly the effect of people not coming here like they used to.
Is that because of the trade ongoings?
Part of that. I mean, I watch hockey games, and you see American teams playing teams in Canada, and during the national anthem, they're booing. So I think that's a measure of the sentiment and why they might not be coming here.
So, Clint, turning to you with the flight equation here, domestic flights down year over year, but we still are hearing about sticky prices and how even over the past month or so, we've seen this rise in airline fares. How is that translating over to the consumer side?
So it's really interesting. Like AAA, we did a study with PointsPath finding that Labor Day travel down 6 to 7% overall. But we're not seeing that with holiday travel so far. So we just, fresh off the presses this morning, I wrote a story. We're seeing price increases actually for Thanksgiving and Christmas this year. Now, they will fall again before people are booking in around October. But yeah, prices ticking back up a little bit. Demand has fallen some. That's why we've seen what I was calling the summer of savings. So we did see reduced prices for airfare, which I'm sure AAA confirmed, but definitely that may be changing slightly as airlines have started to get smart with pricing, with schedules. They're reducing capacity slightly, so they may be winning a little war of attrition with consumers.
When it comes to that holiday travel, is there a way to game the system in any way to maybe book earlier on certain days?
Yeah, absolutely.
What's true?
So the Points Guy advice generally is for domestic flights, you book 1 to 3 months ahead of time. For international, 3 to 5 months. We won't go into that perfect pricing window until October. So what I would tell people is set a Google Flight price alert right now, monitor prices. If you see a deal, jump on it, but you don't have to feel pressure to book until around October. That's when prices start really skyrocketing up as we get closer to the holidays. But Google Flights Explorer is a great hack. Track prices, use points and miles if you've got them. Those points and miles only lose value over time. So points inflation, points devaluations is real. So if you've got a stockpile, use those instead of spending your hard-earned cash.
And Robert, considering where we're at with gas prices, are we seeing any types of changes when it comes to maybe consumers opting for road trips instead of flying?
Well, we've done surveys and asking drivers what the pain point was for the price of gasoline, and both times, 40% of drivers said $3 a gallon. That at that price point, they would have to pull back in other parts of the family budget, not make a major purchase. Drive less, combine errands with their commutes. And that dovetails with information I've seen from Empower that says that 37% of Americans don't have $400 for an emergency expense. We did a survey, and again, 40% of drivers said they didn't have $1,000 for an emergency vehicle repair. So there's this core 40% that are having problems with the economy still. And if you look at demand for gasoline, with where the price is, we should see demand through the roof, particularly during the summer. We're just not seeing that. It was 8.5, 9 million barrels per day. In years gone by, it would be 9.5, maybe 10 million barrels per day as far as gasoline demand is concerned. So I think it's a reflection of the fact that the economy is still bad for a lot of people, and we're seeing a pullback in perhaps the amount of driving that we're doing. We don't do the projections per se for Labor Day because we saw 4 or 5 years ago that there was such a precipitous drop-off between what was happening with the 4th of July and Memorial Day compared to Labor Day. The kids are back in school, college kids are back in school, a lot of the elementary school, high school kids are back in school, so there isn't that family trip aspect to it. But like you say, holidays are still very, very popular, and in fact, we're seeing cruising just going through the roof. With people booking, you can book a cruise up to a year out, and we're seeing numbers for Thanksgiving already coming in. We set a record last year for Thanksgiving travel. I think we'll probably see the same thing happen this year, despite the pullback in other areas.
And cruises can sometimes be viewed as more of a value play when it comes to destinations and travel options. Clay, I'm curious if you agree when it comes to the consumer, because we've seen different types of categorizations throughout this earnings season, this bifurcation, higher income, lower income, the consumer's resilient. But have you also seen those cracks underneath the surface?
Absolutely. That's where the weakness is in the discount carriers. That premium market, that's why all the airlines are going into it so hard, because premium economy, business class is selling like crazy. The wealthy consumers are pushing that demand, but the demand has fallen steeply for the back of the cabin, basic economy, for the discount carriers, Southwest, Frontier, Spirit's having a lot of trouble. So definitely mirroring that, we're seeing that sort of two levels. The luxury market is really good, and the middle class, lower middle class market is really tough right now.
What about on the credit card front? Because they're raising those fees on Chase Sapphire Reserve, and it's got me thinking, okay, do I even want to do this with my own credit card? So how are you seeing that play out in that market?
It's the same thing. Like, it's an arms race for the premium credit cards, and then you see consumers pulling back, missing payments on the lower end. But these premium cards are getting better and better. There's a new Alaska Airlines card that's fantastic. But the annual fees are going up on the Chase, on the Amex. So it's a tale of two cities when it comes to credit cards.
Right, and a tale of two consumers, really, as you've been tracking. Now, Robert, heading into this weekend, I don't know where you're going. I'm going to the Jersey Shore. Where are some of those top destinations?
Well, very interestingly, the top 3 destinations are Seattle, Orlando, and New York. Orlando, we know why. The theme parks, all that's going on there. New York is what it is. There's plenty to see and do here. But Seattle, there was a bit curious. That's number 1 in the domestic destinations, according to our surveys. Also, number 1 in the international destinations is Vancouver. Seattle and Vancouver are jumping off points for cruising, particularly to Alaska. And Anchorage, I think, is number 5 or 6 in the top 10 most popular destinations. So again, a reflection of cruising and its popularity. Pay one price. If you pay for your drinks up front, you know exactly what you're going to pay for that trip. No surprises when you take the family out to the restaurant and when the bill comes. So I think that's the reason it's very, very popular. And the ships that they have these days are just insane. They're huge, and they have all sorts of themes going on them. Just great big, and you can cruise out of just about any coast.
Yeah.
So if your major population centers around the coast, the east, the Gulf Coast, and the west coast, there's probably a cruise port nearby. You can drive there, park your vehicle, ascend the gangplank, somebody sticks a drink in your hand, and the party starts.
Yeah,
It's very popular.
I cover Disney very closely, and
Yeah.
they've been really doubling down on cruises, and I got to tour one of their cruise ships too, so I can see that. But I hope you guys can now head off to your Labor Day weekends. I'm excited. Thank you so much for joining us, Robert Clint. Appreciate it.
Thank you.
All of your market action straight ahead. Stay tuned. You're watching Market Catalysts. Now time for some of today's trending tickers. We're watching Ulta, Petco, and Ambarella. First up, shares of Ulta sliding despite the beauty retailer raising its full-year guidance for sales and profit. Sales rose nearly 10% in the quarter, and same-store sales were up nearly 7%. Despite that growth, Ulta warning of a potential consumer slowdown as the year continues, with the company's CFO saying they believe it's prudent to take a cautious approach. Next, shares of Petco popping double digits after the company showed improvement in profitability and raised its guidance for the third quarter and the fiscal year. RBC Capital analysts writing Petco is making progress on its turnaround plan. Bloomberg reporting options on the stock also rising in the wake of that positive report. Finally, shares of chip designer Ambarella popping the most since 2021 after posting stronger than expected sales in the second quarter and raising its expectations for the full year. The company now expecting annual sales growth between 31 and 35%, around $380 million. Ambarella reporting strong demand for Edge AI. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, today marks the end of the de minimis exemption. That's the tax loophole that allowed packages worth less than $800 to enter the U.S. tariff-free. De minimis shipments make up a lot of the packages Americans receive. U.S. Customs and Border Protection processed 1.36 billion de minimis shipments in 2024. That's about 4 million packages a day. So how are retailers and wholesalers preparing for this change? Joining me now is Brett Rose, CEO of United National Consumer Suppliers. The wholesale distributor works with more than 120,000 retailers, including Walmart, Macy's, TJX, Sam's Club, Amazon resellers, Dollar Tree, and many others. So Brett, you are the perfect voice to have today. So let's start there. The de minimis exemption, we knew this was coming. Have we seen the supply chain been preparing ahead of this moment, and how has that gone?
You know, Ali, it's an interesting opportunity for U.S. retailers because that 1.4 billion you were just discussing, the two biggest people it's going to hit are Shein and Temu. So what it's going to do is shift a lot of American consumerism from online. It's not the online shopping isn't disappearing, but all of a sudden a purchase she may have made, by phone or instant, now she's walking in the store and making the purchase. So it actually, if you look at it a different way, the end of de minimis poses a really interesting opportunity for a traditional brick and mortar retail to capture the business.
Okay, interesting. So maybe more you go to the store than purchase online. And Shein and Temu, this went into effect a few months ago. So how has that impacted sort of their sales and what we're seeing on that side?
Yeah, so on the retail side, we're actually seeing almost category agnostic, where I think people would buy more. I'm going to buy back to school season because they can click a button and buy it on Temu. What's happening now is she's walking into the store and seeing it priced right and buying it ahead of time. So we saw back to school in, April, May, June. We're seeing heavy Christmas in June, July, and August. Everything almost got pushed ahead because what's happening now is when the consumer sees it, she buys it. She's hedging, tariff uncertainty. She's hedging a potential inflation. It's really inflationary tactics through retail shopping, and it's something they can control. So it's forced an earlier purchase.
Right, so pushed ahead. So what does that mean heading into the end of the year? Could we potentially see inventory maybe not as robust as it's been in the past, so maybe emptier shelves?
Yeah, we saw it in March 2025, inventory levels were much lower than we expected. And that was a combination of really intelligent AI, so there was lean purchases, and heavy consumerism, right? You had people fearful of what prices were going to do. Thus far, prices haven't spiked tremendously, but there's still a ton of uncertainty, right? American consumerism is really being played right now as a political pawn. So it's too much confusion, right, Ali? If you and I worry about this and talk about this every day, and we probably truly can't explain how the tariffs are going to affect the American consumer. So imagine how Joe Public is, right? They are doing what they can to control it. I don't think we're going to see empty shelves. What I can say is if you see it and you want it, buy it. Because one, you don't know if it's going to be there, or two, really, the real unknown is what the price is going to be when it is there. But I don't think we're going to see bare bone shelves this year. I don't.
And how are you looking at the de minimis exemption on top of all of the tariffs that we've seen as well?
Yeah, I feel like I'm eating, breathing, sleeping tariffs lately. It's become a topic of conversation even at my dinner table with my 12 and 14-year-old. We're seeing upticks in off-price retailers, and I'll give you a great example. If you look at sort of the big guys, the TJs, the Ross, the Five Below, the Dollar General, you're talking about guys. I mean, Five Below is up 75% the last 6 months since the tariff adjustment. TJX 11%, Ross just 10%, right? So what's happening is she's moving her shopping patterns to maybe a retailer where before she wouldn't. And we're also replacing. We're not trading down like everybody's saying we're replacing. So instead of buying, pick it, right? This brand cell phone case, I will just buy the cell phone case I want because it's there. Instead of buying a Joe Malone candle, I'm going to buy a really great candle that's still priced right, but I can walk into TJ's, Ross, Marshall's, and really still find the brands at a lower price. Maybe it's last season, but the average consumer on most categories, it doesn't matter.
Okay, so not trading down, replacing. Can you dig into a little bit more of what you mean by that?
Yeah, sort of elaborate on what I just touched upon. When you look at the off-price format, right? Walk into a Home Goods, walk into a TJ's, walk into a Marshall's. This is big branded stuff. Even if you walk into a Dollar Tree does an amazing job of having sort of private label for someone that wants to trade down to be a little bit more cost conscious next to Colgate Palmolive on the shelf, and they're doing such a good job. The street loves it, and they're up 75%, right, over half a year. So I think what's happening is the U.S. consumer has become a little bit brand agnostic, but they get the item that they want. The candle example. Maybe it doesn't have to be Crayola crayons, but maybe they'll find a similar branded crayons. So when Junior goes to kindergarten, he still has the item. But by the way, they can also go into a Dollar Tree or a Five Below and capture the Crayola at a slightly lower price. So there's ways for the consumer to hedge the market based on where they shop. And there's phenomenal opportunities out there.
Right, so the label doesn't matter. I imagine that is a really bad thing for some of those luxury companies out there, and we've seen that on the fashion side. How are you looking at the luxury side of this market and really the higher income consumer too?
Right, it's interesting, sort of similar to the points guy that was on before me. Louis is not taking a hit. Hermes is not taking a hit. You can't find their items and their stock is up. It's sort of the middle of the road, right? So you have manufacturers like a Tommy or a Ralph Lauren, a Michael Kors that have really had to get creative, and they've actually produced, different quality items for different segments. You can walk into an off-price retailer and find the same Michael Kors bag that you find at a Neiman's or a Macy's, or you might find a slightly simplified version. Not giving up quality, maybe you're trading down a little bit, but it still allows her to have that same brand. So, the other thing is, I think years ago, we had a Neiman's consumer, a Saks consumer. It was a Neiman's and Saks consumer. Now, pull into any mall, I challenge you, where there's a Marshall's or a TJ's, even a Target, and look at the cars in the parking lot. It's the same consumer. Whether your average home income is $40,000 or your average home income is $180,000, you want to save. A deal is a deal regardless of where you're at financially.
Yeah, and I guess to follow up on that, we talk a lot about the higher income versus lower income, but where does that leave the middle income consumer? And I know you work with a lot of these brands, a lot of these companies on the supply chain side. What's your perspective? Does that middle income consumer still exist?
Oh, 100%. I think the sort of the middle class and the middle consumer is alive and well. And I also think there's tremendous opportunities for them to capture what they want. And, maybe you're not walking away with a Louis or a Patek on your wrist, right? But there are still tremendous opportunities for the middle consumer to still capture an item, a luxury item, to make her feel better, to make him feel more confident. The deals are out there. The trade is where are you making the purchase and when are you making the purchase? So it still allows you to feel good. Amongst the chaos of COVID, amongst the chaos of an inflation and just really the everyday world, consumerism is alive and well because it's something we can control. It's a dopamine release that we can do to make ourselves feel good. And really that sort of transcends across everything we do. But I think the middle class and the middle class consumer is alive and well.
All right, Brett, super interesting stuff. Thanks so much. Appreciate your time.
Thanks, Allie.
Coming up, why one expert says now is the time for investors to take a closer look at regional bank stocks.
All right, well, big banks beating the market over the last year, and of late, that's driven by growing hopes the Fed will begin cutting interest rates in September, but questions still remain around whether this momentum will last or if upcoming economic data could shake up the Fed's interest rate path. We're navigating how to play the banking sector with the Yahoo Finance playbook. Joining me now is David Ellison, portfolio manager at Hennessy Funds, and we are still joined by Tom Hayes with Great Hill Capital. David, let's start something that you flagged in your note to us, which quite interesting for the banking sector. I know it's been talked about over the last few months or so, the M&A outlook. Haven't seen a ton of action here for quite some time. Where are you looking to play that, or how are you playing it? And just what does that do for the overall sector, the overall industry, really, kind of getting unfrozen here after almost 2 decades?
Yeah, I think the last comment, unfrozen, after 2 decades, it's been a long 10, 15 years. The regulatory structure obviously tightened down after 2008, and they haven't been able to breathe for a long time. And the hope, I think, is that we will continue to see sort of a deregulatory push, and that will create, acquisition activities, not only in the traditional banks, but in the non-traditional banks. So I think it's, that's historically been a big value creator for investors like myself. Banking is typically a kind of a boring business. It's a get rich slowly process, but the acquisition process sort of accelerates that and gives you opportunities that you wouldn't otherwise have.
And Tom, for your for your portfolios, your work, thinking about how where the financials fit into that, are there any names that you like, any ways that you've positioned, or I guess maybe just sort of a macro view on the sector and how it feeds into some other trades?
Yeah, 2 things. I would say if I'm going to play banks tomorrow, I'd be playing regional banks. I'd be playing the small caps. I think there's more upside there. I think there's going to be a lot of refinancing happening. If you look at earnings growth of small caps, 35% next year, trading at 17 times versus large cap or S&P 500, 13% earnings growth next year, trading at 22 times. So that's helpful. Our biggest financial position, believe it or not, is PayPal. It's been left for dead. Alex Chris came from Intuit. He ran the small business division, had a huge multi-bagger there. He's doing some innovative things at PayPal. They're generating record free cash, buying record amounts of shares back, doing a lot of stuff with Venmo, with PayPal. Their transaction margin is expanding. So I like the innovation in the international aspect. They're one of the top stable coin issuers. Most people don't know that about PayPal, so they're on the cutting edge, believe it or not. And 435 million users around the world. So it's very hard to destroy that when you're generating that kind of free cash flow. So we're playing it in a non-traditional way at the moment, but I do see the M&A story, I do see the banking story, but I'd play it on the smaller bank side to the point that he was making about the deals.
David, it's interesting. PayPal is a name that you flagged to us in your note, and also just that broader, and Tom mentioned the stablecoin trade, that broader, whether you want to call it crypto, fintech, like let's say next generation banking. How are you thinking about that role, and what names might fit into your portfolios, your funds as a result of these changes?
Well, I think there's a lot of names that fit there now. I think the issue has been that the traditional banks have lost share to private equity, private debt, to things like PayPal, to you name the you look at Hood, you look at Coinbase, you look at even something like a Rocket. These are all companies that are taking share, and this gets back to sort of the M&A side of it. The banks have to find a way to sort of recapture that momentum and get share back, and M&A is a way to do that. Entering the businesses are a way to do that. So I think the 3 things I look at is the value of M&A in this business, the value of new products and services that the deregulation will bring, and the benefit of hopefully some sort of use of AI to cut costs. I think if you go back 40 years ago, and that was when I kind of started 45 years ago, the returns on equity and assets of the industry is about the same as it is today. And so they really have not improved the metrics of the industry, and yet a lot of these other companies, like the Mag 7 that everybody talks, they earn 4 or 5 times on assets and equity that the banks do. And hence the valuation, they grow a lot more, they have new products, they innovate. And that's what the industry needs to get the valuation back that it used to have. And I think hopefully we'll see that in the next couple of years.
And David, speaking of the traditional business for these banks, we've seen a very strong M&A market just for the investment banking arms of these firms over the summer. We've certainly seen the IPO market coming back. How does that factor into your thought around some of these firms, and particularly the major money center banks, the bulge bracket banks that we're more often talking about than some of the smaller players?
Well, the bigger banks have done better because I think people view them as more diversified, less sensitive to rates, less sensitive to the yield curve, although the yield curve has improved of late, less sensitive to sort of minutia regulations. And they also have the money to invest. They have the profits, and presumably they can hire people and pay them appropriately to generate either the AI products or the new products, or do acquisitions, or deal with the regulatory structure. So they have the advantage of size and profitability, and you throw in some decent Wall Street stuff and it's pretty good. But again, Wall Street is not, Wall Street income to me is episodic, and it's what have you done for me lately? The issue is, generating growth in all of the businesses. And I think that's something that, they're trying to do. And I think some people are doing it better than others, but there's still a lot of margin and profit improvement that needs to happen here to, get the stocks to go up even more from here.
All right, we'll leave it there. David Ellison with Hennessy Funds. Thanks so much for the time.
Yep.
Consumer spending data for July showing signs of resilience despite elevated inflation. But cost-conscious consumers are rethinking how they spend their money, especially when it comes to vacations. ResortPass, which offers day passes to thousands of hotels, noting that customers are taking a wait-and-see approach for bookings. Joining us now in studio is the CEO of ResortPass, Michael Wolf. And Michael, you are seeing strong bookings for one-day vacations in September, which I guess is maybe a little palate cleanser after the summer craziness. So what is that telling us about the consumer and their spending habits right now?
Yeah, I think people want these moments of rest and recharge, but they want to do it locally and they want to do it in a more price accessible way. So we work with hotels and have passes starting as low as $20 and go up to $200 for kind of more premium platforms. But overall, people want the moments of rest and recharge, but they want to do it a little bit closer to home in a more accessible way.
Yeah, 80% is local, right? So that just means in your backyard?
Yeah, exactly. So, 3 times as many people will travel within 50, 100 miles this weekend as will kind of get on a flight. And so there's so many more people who are going to have a great weekend, but kind of do it a little closer to home. And so we're kind of able to supplement that with kind of a great day of rest and recharge at a local hotel.
So talk to me about the pass. What exactly does it get you? How much does it cost? Does it change depending on the amenities you have access to?
Yeah, so it really varies. So we work with over 2,200 of truly the world's best hotels across every major hotel flag: Hilton, Marriott, Accor, Four Seasons, Auberge. And so the prices, are quite different because we work with such a range of properties, and the amenities you get access are different because each hotel or resort has slightly different amenities. But there really is something for everyone. Is kind of the good match. We have things that are great for families. Maybe there's some water slides. We have more quiet pools, infinity pools, if you want a little more solo time. So there's really kind of a match for exactly how you want to rest and recharge.
Are you seeing any change when it comes to which hotels folks are gravitating towards more? For example, I know the consumer has been under a bit of pressure with inflation, with tariffs. Are they not going to the Ritz-Carltons of the world as often as they maybe were before?
I think with us, we really have such a varying type of customer. So you see people who kind of access the more accessible hotels that might start at $25, $30. But actually some of our fastest growing hotels are the more premium hotels. I think a lot of the luxury segment has seen that they can only raise rate so much. There's 5 times as many hotels where the average daily rate of hotels right now is over $1,000 as there was 3 years ago. So they've really pushed up rate. But then where are you going to get your growth from? There's only so much you can do that. So they're looking to ancillary revenue across all the other surfaces of the hotel, which is where we come in.
So is that why hotels are interested? They want to try and find those pockets of revenue and maybe some of that brand recognition too?
Exactly. So occupancy really hasn't gone up at hotels. They've just been pushing price as a way of kind of seeing their growth. There's only so much you can do that. And so they're saying, hey, we're so smart and sophisticated around revenue management, yield management of the room product. They've never applied those same lessons to every other surface of the hotel. And that's what they're doing with ResortPass.
And you're backed by some high-profile investors, David Rubenstein's Declaration Fund, the Points Guy. What's the creative and strategic vision that they're helping you get to? Is there more growth that you want to do, more expansion plans, maybe domestically or internationally?
Yeah, I think the idea of a vacation, the idea of the single day in rest and recharge is something that we're just at the beginning stages of. People want these feelings. They want to get at that kind of, we call it vacation brain internally, but there's never been a platform to allow them to get at it. So historically, you might have had that one vacation, maybe two, which is what most Americans take every year. What's that ongoing way of feeling like that? And that's kind of what we do.
So is that why you're seeing maybe these short stint vacations rather than taking off a week or two? Customers now have the option to maybe just do a day or two, and with your app, you can feel more luxurious.
You can feel more luxurious, you can do it really quickly. So you think about all the labor, the time, the cost involved with travel. Think about with us, you press one button and not exaggerating, within 15, 20 minutes, you can have this experience. 40% of our reservations are within a 24-hour period because people just kind of crave that feeling and we get it to them as quickly as possible.
Is there a cap when it comes to how many people can get into a certain hotel?
Yeah, we're really smart about that. We want to make sure that we optimize the experience for the overnight guests as well as for our day guests. But to give you a sense, just last month alone, we sent 250,000 people to hotels.
Have you seen any pushback on maybe the hotels themselves that have guests that are paying that high premium to stay there, and now they have folks sort of overflowing the pool area? How would you respond to any of that criticism?
Never overflowing. We always, again, we have really sophisticated tools here to make sure that it's the right amount of people. But remember, even the most luxurious hotels in the world historically have welcomed people maybe to their bar, to their restaurant. And the overnight guest is often actually, do they know if the person sitting next to them at the restaurant is, room 312 or lives down the block? And not only do they care, and in fact, I would argue that actually kind of putting that person who's local with the traveler kind of creates a more rich travel experience because you get to kind of immerse yourself more in the local culture. So it's really no different than that. We're just doing it with the other services of the hotel.
And you came from ClassPass, which basically gives you points and you can go and book at different workout studios. I am a ClassPass member. What were the lessons learned from that business and really your experience in more of startup cultures?
Yeah, I think on the kind of team building, hiring is so important. I can spend 70% of my day sometimes on the hiring. And the other thing is really having great relationships with your partners. So one of the things that I'm most proud of is that we work incredibly closely with our hotels, and it's not just the ownership or the general manager of the hotel who we have really strong relationships. It's the individual servers who are seeing more in tips. And during some of these quieter times, it's busier for them, and they kind of have more hours that they're given. So when I go to our hotels and visit our partners, some of the most love I get is from the person who's serving a drink by the pool, which is just really fulfilling for me.
Mm-hmm. And long-term play here, would you ever want to bring this idea maybe to public markets or be acquired? What would be your ideal vision?
Yeah, right now we're focused very much on building a company. I think we're at the earliest stages of creating truly a new category. But when we have any news on that, I'll be sure to come back.
Give me a call there, Michael. I appreciate it so much. Thank you again for joining. And it's Labor Day weekend, so I'm sure a lot of folks will be on ResortPass. Appreciate it. But that's all for Market Catalyst. I'm Allie Canal. Thank you so much for watching. More Yahoo Finance ahead.